attendees who are attending now, people can join on later on. But my name is Cherish De La Cruz, and I am an estate planning attorney in Buckhead. I do live in Gwinnett. And Raymond is a wonderful financial advisor and CPA. And we were having a discussion a couple of weeks back, and we decided to, 2020 has been a difficult year. And so we started to think about, okay, what are some things that we can discuss that would be helpful to both our personal and business clients? And we came up with this webinar. I think because there was so much uncertainty this year, that we wanted to make sure that our clients had a resource available to them for a solid foundation to begin 2021. And so this webinar will address some of the key strategies, both personally and business-wise, that you should take in preparing for a successful 2021. I've known Raymond for several years. He is my CPA and advisor. And so I enjoy working with him. And the perspective that he takes is fantastic because he's always considering the tax implications from a holistic view, both personally and business-wise. Raymond, do you want to tell everybody a little bit about yourself?
Yeah, so first, Cherish, I want to thank you and your team for pulling this together. As Cherish said, that I'm Ray Payne. I'm a financial advisor and CPA. My office is in Tucker. I have been a CPA since, well, I won't say how long, but a long time ago. And we're a holistic financial advisor. So we look at the tax implications just about with everything that we do from an investment standpoint, from a financial planning standpoint, obviously, because they all relate and they intersect. And so we really do take a holistic approach to planning. And I'm really excited to be here and talk about year-end planning on things that we can do before the year is out to not have a disappointing or distressing April 15th. So Cherish, thank you again for having me.
Great. Now, the agenda today, we're going to look at the personal legal strategies that you should be taking to protect yourself. We're also looking at the business legal strategies that you can to protect yourself and your business. After I discuss those things, Raymond is going to talk about year-end tax planning for personal and then year-end tax planning for business. And we will have some questions and answer period afterwards. If you do have any questions, or you can reach out to us and we'll provide that contact information. Now, one thing that 2020 has given to me is a different type of perspective. So, and I think for both my personal and business clients, we have had time to focus on what is our own individual purpose, what is our business purpose, what relationships are important to us, and how we can, and how important they are so that we want to protect them. I think a lot of my clients who are both my business clients and personal clients, they've had time to reflect on, the importance of planning. And prior to the pandemic, sometimes it was like pulling teeth to get people to think about planning. Obviously, it's not a fun topic, but they realized through this pandemic that ultimately, all the hard work that they have done, they want to make sure that they protect themselves and they want to protect their loved ones. And unfortunately, COVID has brought that into reality, being at home with their family members. Now, my own personal estate planning journey and why I went into estate planning was because of my aunt, Mimi Bell, who's pictured there. She's the one with the yellow flower. She was like a second mother to me. And unfortunately, in 2000, 10, she was diagnosed with a rare form of appendix cancer. And I was a securities compliance lawyer at the time. I had no idea what proper planning was. I knew that I needed to have some type of will in place for her. And, that was about it. I didn't know about advanced directives. I didn't know about holistic planning. And I didn't realize how important all of that would come into play. And so, although I was helping her with the process, I didn't realize that you needed an estate planning attorney who would take all of that into account, the personal dynamic factors, the fact that she was divorced, the fact that she had international properties. And so, although we walked out with a will when we went to a general attorney out in Wisconsin, the consequences of quick, simple, and efficient planning weren't necessarily conducive to my aunt's goals and to the family harmony that she wanted to preserve. And, to the right there, that is my continued why. I enjoy working with all types of clients, but this is my daily purpose, my 3 children to the right. And so in evaluating that, I've realized this year, and a lot of my clients have realized, that we need to put those things in place. Peace of mind and planning for our family members isn't really for us, it's for our loved ones. So, in talking about what is a good estate plan, and really what is an estate plan? So, an estate is everything that you own. It's your houses, your cars, your 401k, any annuities, life insurance. It's the tchotchkes that you have in your house. It's those personal mementos that are important to you as an individual and maybe important to your family. Now, the foundation of a good estate plan is really having some key things in place, and these are outlined here. You need to have a will or a trust, an advanced health care directive specifically for Georgia, because I am in Georgia, a financial power of attorney, and then also a HIPAA release. Now, a will is something that a probate court supervises. It's public record. And, people have more of an opportunity to object to that when it's submitted to the probate court. It can take anywhere from 3 months to, now it's taking a little bit longer because of COVID, to about a year or several years, depending on how complicated your estate is. Now, a trust, think of a trust as a contract for your beneficiaries. It's, I like to use the analogy of a bucket, and you're putting assets into that bucket for the benefit of your beneficiaries. Now, beneficiaries are the people that you want to leave your things and assets to. I think a trust is good in terms if you want to leave certain conditions. So for the 3 children that I have, I don't want I don't want my children to have access to those assets right away. If something were to happen to myself or my husband, and I would want to make sure that that it's given them to, if they reach certain milestones or markers or conditions. Now, an advanced health care directive, you see this all the time right now in the news. Making sure that you have somebody to speak on your behalf if you're incapacitated. God forbid that you're in the hospital and you can't speak for yourself. Who is that individual that you want to appoint to speak on your behalf? And then also, if you did get sick, having a financial power of attorney in place. This allows an agent to speak on your behalf and to do the things that you would normally do, like, paying your mortgage, managing your business potentially. It all depends on your own unique situation. But really, you need somebody who is going to do that is customized for your family and your business situation. Now, with COVID and with the pandemic, this is a key component. The advanced healthcare, it identifies the decision makers. It asks you to think about hard questions about end of life decisions. And you really need to be getting with an attorney who's sensitive to that, who understands the complexities of those decisions, and who explains it to you in a way that you understand. So there's the end of life directives. And one thing, I've been there with clients when we are at the end of life, where hard decisions that haven't been necessarily contemplated before are being contemplated in the present moment. So somebody who doesn't understand, whether or not, their daughter wanted to donate their organs, things like that. And it's stressful. So it really is a roadmap and a clear statement of an intent of your loved ones. Also, unfortunately, we're seeing a lot of older people with, developing dementia and Alzheimer's, and it gives them direction and appoint somebody to speak on your behalf. So for my business owners, and Ray's going to discuss this a little bit more, but as we're planning for the end of the year, and one thing that we have found in our practice is that you want to evaluate the business structure that you're having right now. Is it still right for you? And so it's important to have all of the key advisors that you have in place, and saying, okay, what does this mean since tax, there's been so many tax changes over the years. Is this still a good strategy? You want to have your CPA, your financial advisor, maybe your business coach or consultant to see, is this the best structure in terms of longevity and future planning? Does this make sense still for you as a business owner? So, determining whether or not you have, is it good to still be a sole proprietorship? Are there additional asset protections that you need to take in place? And then also from a corporate perspective, is it better to be a C corporation or an S corporation? And so I've been having these conversations with my clients and their respective advisors. And so one thing is, as we're preparing for the next year, making sure that your company's record keeping is up to date. One thing that I've learned over, I saw this, and this was really highlighted this year because of the EIDL and the PPP loans. Record keeping is key, not only for asset protection, and making sure that all of your documents and everything is in order, but like if you're contemplating a future sale of your business, is your company keeping good records of its income and expenses? Are you keeping track of all of your contracts? Who are the vendors? How much are you paying them? And then in terms of employee records, do you have those? And then also making sure that you're coordinating with your CPA and making sure that all of the tax filings that are required are being maintained. And then one thing that my business clients have been thinking about is they've been evaluating their operating agreement or their shareholder agreement. The partner that you went into business with 25 years ago, where you might have had a handwritten contract or, just something that was thrown together fairly quickly. Is it still a good agreement today? And have the circumstances of your business when you started 25 years ago or 5 years ago, 10 years ago, is it still applicable? Are those things where you contemplated, death of a partner or, disability? Really evaluate those provisions with your attorney and say, okay, is this still applicable today? Because as we have seen with COVID, certain things can change in an instant, and the long-lasting ramifications of an agreement that you might have signed 10 years ago, 5 years ago, can really play an impact on that. And if you don't have a buy-sell agreement, and you have a partner, or you have several partners, or you have several shareholders in a corporation, it's important. You need that. You need to contemplate how you're going to protect your own interest and how you're going to protect your other partners or other owners or shareholders' interest as well too. Because the last thing that you want to do is be confronted with a situation where something, unexpected happens and you are not prepared. So that, you either have a fire sale of the business, which means, you're looking for immediate buyers, which does not put you strategically in a place that you want to be in when you're trying to either sell a company or sell the shares of a company. And then you should also think about, having a valuation done. What does that mean for the business? And start, a lot of my clients at this point are thinking about, what does the future transition look like? Should I hold on to this? Should I try to build my business for value? And how do I do that? I think a lot of business owners were scared this year in particular because they were thinking they were going to exit in the next year. But maybe they're taking a step back, evaluating what can be done to build value. And the longer time horizon you have, the better it is for you. And then in terms of, if you do have a buy-sell agreement, if the insurance or the money that was set aside, or the value that you assign to that particular share, is it still relevant today? And is it properly funded? So, maybe when you started your business 10 years ago, you funded it with a $100,000 life insurance policy. But now the value of your company is in the multi-million dollars. So is it adequate? And just making sure that those are the key changes.
All right. Thank you, Chair. So I'm going to start out by talking about year-end tax strategies for individuals. And I'm going to preface by saying I am from Alabama, which means that I talk slow. So I'm going to try not to go into too much detail so I can leave time for questions, but I'm just going to ask you to bear with me as I go through this and try not to get bogged down. And I really do want to leave time for questions at the end. So first thing is, at year end, the best thing that you can do is to shelter income, if you're an individual. And so the easiest way to do that is to max out your qualified plan. So if you are an employee and your employer provides a 401k, 403b, or 457 plan, the maximum you can put into your qualified plan is $19,500. If you haven't reached that, then use the last 6 weeks of the year to increase your contributions to max that out to shelter income. And if you are 50 years of age or younger, really older, you can put in an additional $6,500. So for a total of $26,000 if you're age 50 or up in a employer qualified plan. If you're self-employed and you have a simple plan, you can put up to $13,500 or an additional $3,000 if you are 50 and up. And I'll talk about some of the qualified plan contribution limits for business owners later on in the couple slides down. The other thing that I want to talk about is just being mindful of your income if you make Roth IRA contributions, or if you want to make Roth IRA contributions. If you are contributing to a Roth IRA that is outside of your employer's plan, meaning that your employer doesn't provide a Roth 401k option, but you're just contributing to it outside of that, your income has to be below $139,000 if you're single, or $206,000 if you're married filing a joint return to make a full contribution. Cherish, if you can go back to that last slide. Okay, you're fine, thanks. And if you are under the age of 50, you can contribute $6,000 a year to a Roth, or $7,000 if you're 50 or older. However, if you work for a company that provides for a Roth 401k contribution, it doesn't matter how much your income is. So the income limits are not attributable to you if you're contributing to a Roth inside of your employer's plan. So you can make as much as you want. You still have to stay within the $26,000 contribution limit. So you get to contribute more to the Roth inside of an employer's plan, and you're not subject to the income limitations. But if you're not doing that and you still wanting to make a Roth contribution, you have to be mindful of your income. And just from a planning perspective, I do advise our clients to build a pot of money for retirement that is tax-free, meaning in a Roth, versus having everything go in pre-tax and via your traditional qualified plan contributions. The reason for that is because, as you know, with the Roth, that money grows for you tax-free for the rest of your life, and you don't have to take required minimum distributions out of a Roth IRA. So in a qualified plan that you've contributed to on a pre-tax basis, keep in mind you've got an embedded tax liability with that. So as you start to draw funds out of that plan, you're going to have to pay income taxes. So if you have $1 million inside of a 401k plan, you don't, on an after-tax basis, you have something, closer to 750,000, or maybe even less, maybe closer to $700,000 on an after-tax basis that you can actually bring home and use. So having all your money inside of a pre-tax plan isn't necessarily the best thing to do from a financial planning perspective. And so I want to encourage all of you, if you have a Roth 401k option with your employer, to take advantage of it. And if you've already built up a sizable amount in the pre-tax portion, start contributing the majority of your future contributions to the Roth. It does mean that your current taxes will be a little bit higher than they would otherwise be, but you will grow a pot of money on a tax-free basis. And the final point I want to make on this slide, as far as year-end tax planning, is harvest your capital losses against your capital gains. So we've had a really volatile year this year. So if you were someone that maybe panicked in March when the stock market fell off a cliff and you've got all these capital losses, but you held on to some of your investments and they've now appreciated really nicely, then you've got some and you have some realized capital gains, then you can take those losses that you incurred back in March and offset those losses against your capital gains to reduce your taxable income number. Because otherwise, your capital losses, long-term and short-term capital losses, can only offset your other income by $3,000. And otherwise, you've got to carry those losses forward to future years until you can use them against future capital gains, or take them $3,000 at a time against your other income. And Cherish, you can go to the next slide. Also, because the standard deduction increased with the 2017 tax law change to $12,000 for individuals and $24,000 for couples filing a joint return, a lot of people that in the past have been able to take itemized deductions are not meeting that $24,000 threshold. And so they're having to take the standard deduction. So one of the things that we found that's been beneficial to our clients is for them to take their charitable contributions every other year, meaning just being strategic, waiting every other year, making very large charitable contributions every other year. That's going to push their standard deduction above the $12,000 or the $24,000 threshold, so that you're able to itemize. So this could mean for some of you that you're itemizing every other year. But it could be for others that, you know what, it doesn't really matter because you may not have a mortgage, or you may live in a low tax state, and you're just not going to reach that threshold. But if you're, kind of bumping up between, if you're married, filing joint, $20,000 of itemized deductions, then just hold off on making some of your charitable contributions to the following year. That will push you up above the $24,000 threshold. The other point I want to make on that, and this relates to state taxes, if you take the standard deduction on your federal return in Georgia, you have to take the standard deduction on your state return. So if you're someone and you've got $22,000 of itemized deductions, and you take the standard deduction because it's $24,000, just know that for Georgia, the standard deduction is only $600. So you lose a lot of deductions by taking that standard deduction on your federal return. So for our clients, we found that they're in that situation, particularly once they get to $20,000 of itemized deduction, we'll just take the itemized deduction, meaning that they pay a little bit more on the federal taxes, but they pay a whole lot less on their state return than they would by taking the standard on both. The next point is for those of you that are old enough to have kids in college, don't forget to get the tuition statement from your college student. The universities will send the 1098-T to the student. They won't send it to you or to your home unless your student is living at home. So you'll have, and particularly if your student is a freshman, they won't know that they're supposed to be looking for one. The reason why the 1098-T is important is because you can use the tuition and fees deduction on your tax return to either reduce your taxable income or take the American Opportunity and Lifetime Learning tax credit. So it's really important, particularly for those of you that may have students that are in college for the first time, ask them for the 1098-T, and always remember to continue to ask them for it in future years, because the universities will send it to the student and not to the parent. Final point on this slide is that due to the CARES Act, you are not required to make required minimum distributions in 2020. So typically, if you're 70 and a half, you're required to take distributions from your 401k or IRA or any other qualified plan that you have. But the legislation that was passed this year allows you to forego that. So if you don't need to take the distributions, you can not take that distribution and wait till next year to take your annual required minimum distribution. And the rest of these points are specifically for Georgia taxes. So for those of you that live in Georgia, so a couple of things to keep in mind, that the college savings plan, the Georgia 529, the deduction has doubled. In previous years, it was $4,000 per child for a married filing joint return. That's now $8,000. So if you contribute $8,000 per child to the Georgia 529 college savings plan, you can reduce your Georgia taxable income by $8,000, $4,000 if you're single. So that is per child. So in Cherish's case, she can contribute up to $24,000 to a Georgia 529 and have that $24,000 reduce her Georgia taxable income. Contributions made to a college savings plan, not just Georgia, but any, if you decide that you want to contribute to another state's savings plan, they grow 100% tax-free when the funds are used for college tuition and fees. So you would never pay any federal taxes or state taxes on the money you make in a Georgia, in a 529 savings account, whether it's in Georgia or not. Another tax benefit that's unique for Georgia is that you can contribute to a private school K through 12 tax credit of $2,500 that for the school that's been pre-approved. So basically what you're doing is you're taking some of your Georgia tax withholdings and having that be donated to a private school, K through 12, you have to get this pre-approved. The school will typically let you know if they're participating in the program. But if you do, you can reduce your Georgia tax bill dollar for dollar up to $2,500. And the final point on the Georgia film credits is that I don't know if you guys have ever, watched a movie or a show but it's produced in Georgia. You'll see the little Georgia peach come on at the end, where right before the credits start. That means that production was done in Georgia, and that production company receives a tax credit for doing so. So that's why in Georgia you have a lot of film and television production happening here in Georgia. You can actually buy their tax credits. So the state gives these production companies tax credits, and they allow us individuals to buy those tax credits from the production companies. These production companies will typically sell them at a 10 to 15% discount. So in other words, if you have a Georgia tax bill for $10,000, you can buy the tax credit from the production company for $9,000, and that will settle your $10,000 tax bill to the state. So it has to be a pre-approved Georgia film production company, and these credits can be bought, but they can't increase your refund. They can only reduce your liability. So that is something we've done that for our clients. Actually, this year it saves you, a ton of money depending upon how cheaply you can buy the credits from the production company. Okay, so year-end tax strategies for self-employed or small business owners. Again, max out your qualified plan contributions. So if you have an S corp and you have to pay yourself a salary, that's one of the requirements for having an S corp, then 25% of your salary from your S corporation qualifies for a SEP contribution. So you can contribute up to $57,000 to your SEP IRA. The offset to that is that you've got to pay yourself a salary to increase your salary to qualify for that. So one of the things that small business owners try to do, they particularly S corp corporation owners, they want to pay themselves a small salary so that they don't have to pay as much in Social Security taxes. But that also prevents you from increasing the amount that you can put into a retirement plan. So if your primary goal, if at the point in your business cycle and in your life where you want to maximize your retirement contributions, then you have to pay yourself a larger salary in order to be able to put more into your SEP IRA. If you are not an S corporation and you're just an LLC and you file a Schedule C on your tax return, then you can contribute 20% of your profits to a SEP IRA, and that will again allow you to put up to a maximum of $57,000 into a SEP IRA. A couple other things every year I talk to our small business owners about. Delay your December income to January. So again, this is just a matter of timing, but if you know that you are going to send invoices out in early January, why not just, if you can afford to, push those off to January. That decreases your income in the current year, pushes it off to next year. That gives us 12 more months to do planning to try to reduce the following year's income. Conversely, accelerate some of your expenses into December. So pay your January rent early. If you're going to, stock up on supplies in January, go ahead and buy those in December. Again, the whole purpose is to reduce your profitable income in the current year. Give yourself 12 more months to plan and do the same for the following year. For small business owners, there's the provision. We've always had the Section 179 deduction. It's just been greatly expanded in the 2017 tax law, but you can purchase up to $1 million of business equipment and write that entire amount off in 1 year. So most of us here on this call, don't have $1 million to spend on business equipment. But if you do, you have that available to you. So you don't have to take, of course, you don't have to take $1 million. Whatever you buy, whether it's a PC or any type of furniture and equipment for your office, you can write that off up to 100% of that, up to $1 million. Deduct your home office expenses. A lot of people are kind of reluctant to do that. They think that it'll be a red flag, but actually it isn't. It's quite common. Basically, what that means, particularly in today's environment of COVID, a lot of people are working from home. This is only true for those of you who have your own business. It's not the same if you're an employee. If you have your own business, you can deduct, the pro rata portion of your dedicated home office space. You can write that off on your business tax return. So that requires you measuring your office space and taking a pro rata portion of that space over your entire living space and deducting a portion of your utilities, of your property taxes and mortgage, or your rent if you're renting, all of your utilities. Anything that you do just in that office space is 100% deductible. So if you decide to paint your office, if you decide to do new flooring, buy new light fixtures, and that's just for your office space, 100% of that is deductible. Now, for those of you that have an S Corp, another thing that you can do is basically establish an accountable reimbursement plan. And what that is basically saying your business is going to reimburse you, the employee, for your use of your home because it's for the benefit of your business. And so you can, and I have templates that will help you establish that, but basically you can establish a fixed dollar amount that instead of charging your business rent, you're just going to ask your business to reimburse you for your portion of your home office expense. The benefit of doing that is that if you charge your business rent, you've got to pick up that rental income on your personal return as income. But if you do it as a reimbursement via an accountable reimbursement plan, that is tax-free. So you would just be charging your business a fixed dollar amount every month or every year, however frequently you want to do it. And then that is just treated as a reimbursement for if you bought supplies out of your personal pocket for your business and the business reimburses you. That's not income to you, but that is a business expense for your business. So if you establish an accountable reimbursement plan is another way to capture home office expenses and without having to pick up any rental income on the personal side. And that is it. Hopefully I left some time for questions. Cherish, I'm going to turn it back over to you.
Sorry. And so here's our contact information. If anyone has any questions, if you can raise your hand. I did have a question though, Raymond, for you. So in terms of having your own business, can you still do that home office deduction expense, even if you're paying rental income or like you're leasing an office somewhere else?
Yes, you can. So think about it. I mean, most businesses are, it's not unusual for a business to have more than one office space. So if you have office space outside of your home, but you still have dedicated space in your home, you can still take the home office deduction.
Okay. But yeah, no, some really great points. I didn't realize that that you could take a deduction for the 529 for each child. So really, like if you have 4 children or 3 children like I do, that could be like $24,000 off of your income.
Yeah.
Awesome. Great.
Yeah.
Does anyone else have any questions? Oh. Hi, Madeline. Nice to see you. And yeah, I think
Thank
you
you
can.
so
Yeah.
much. Hey, there I am.
Yes, you are.
Thank you for having this event, and I've learned a lot. Raymond, my question is for you on the donate strategically. I'm not sure I understood exactly what you were trying to advise us to do as far as the higher standard deduction for charitable contributions. So I wondered if you could maybe just go over it a little bit again and
Sure.
maybe help me understand.
Sure.
Thank you.
So Madeline, are you single or married?
Married.
Okay, so for you, the standard deduction is 24,000. So let's say that, so anything less than 24,000, you would just take the standard deduction. So even if your taxes, you can deduct up to 10,000, and let's just say that your mortgage interest is 8,000, so that gives you a total of 18,000. And let's just say that you would have $2,000 of charitable contributions. Well, that only brings you up to $20,000. So your $2,000 of charitable contributions would basically go to waste. You wouldn't be able to deduct them because you're taking the standard deduction at 24. So instead of doing that, if you delay that $2,000 charitable contribution to the following year, you don't lose anything because you're taking the standard deduction at 24,000, but you take that $2,000 charitable contribution that you would have made this year to next year, and you pair that up with a larger contribution the subsequent year, such that that contribution takes you above $24,000, then now you're able to take advantage of your charitable contribution on a tax basis because you're able to pair that $2,000 to another $4,000 charitable contribution to bring your itemized deduction to a number greater than 24,000. You're able to take advantage of it. So really what you're really doing is basically bunching your charitable contributions together to take them all in one tax year so that you can take advantage of the of the um, of, of the itemized deduction being over $24,000.
Okay. All right. Well, thank you. That helps me a little bit. I appreciate that.
Oh, you're welcome.
And I do have a question that says for the $2,500 Georgia tax credit for the K-12 to 12 donation, must you have children at that school? I.e., can a single person with no children take advantage of this credit? And then can you explain the difference between the tax credit and deduction?
Yes. So the answer to the first question is yes. No, you don't have to have a child at the school. You don't even have to have children. As a matter of fact, the way that the law is worked, you can make this contribution to a school. You can't even direct your contribution to a particular student. So it goes to the school. The school then uses those monies to provide financial aid to students who otherwise couldn't afford tuitions. But you do not have to have a child at that school. You don't have to have children in order to do that. That's a good question on the difference between a tax deduction and a tax credit. A tax credit is a dollar for dollar reduction in your tax bill. So it's much better to have a tax credit than a tax deduction because a tax deduction only reduces your taxable income. And so because, if you're in let's just say for Georgia tax purposes, if you're in a 6% Georgia tax bracket, $1 deduction from your taxable income reduces your tax by 6 cents. But a dollar tax credit reduces your tax bill by $1. And the same is true on the federal side. But those six cents can add up, if you're talking about, say, $24,000, reducing your Georgia taxable income number by that amount, that's not immaterial. But a tax credit is better than having a tax deduction.
Awesome. Great. Any other questions? Let me just double check here. Don't see anybody else asking questions. Oh, wait, there is one person, Jarrett. Hey, Jarrett. Thanks for joining us today.
Happy to join you. Can you hear me?
Yes. Yeah.
Okay, so my question is, I'm an attorney, but just kind of trying to determine at what point it makes sense going from an LLC to an S corp from a tax point of view, and the more difficult question, like how to set your own income.
Okay, good questions, Jarrett. So we typically advise our clients that once their profit from their business is going to exceed $30,000, you're better off being an S corp than a Schedule C. And the reason is there's some administrative costs for being an S corp. The savings come into play because on $30,000 of profit from your Schedule C business, all $30,000 of that will be subject to self-employment taxes. So now for an attorney, that threshold is most likely going to be a little higher than that. I would probably say maybe once your profit gets to be about $50,000. But at 50,000, let's just say your Schedule C profit's 50,000. Well, you're not an S corp at $50,000, then you're going to pay self-employment taxes on the entire 50. Versus if you become an S corp, then you can pay yourself a salary, let's just say $2,000 a month. And so you're going to pay self-employment taxes on 24,000, not 50. And then the difference will just of your profit from your S corp will just be subject to regular income taxes. So when you're Schedule C, you're going to pay self-employment taxes and income taxes on the full profit from your business. What you're doing with the S corp is you're carving out a portion of your profit to take as salary and pay self-employment tax on that number, but the profit that remains, you're just paying income taxes on it. So for most businesses, it's 30,000. What we found, oh, and I didn't talk about the administrative costs. So you have the cost of filing an extra tax return when you are an S corp. You have the extra costs of, finding a bookkeeper. Cherish talked about, having really good books and record keeping. So most likely you're going to need a bookkeeper to do your books for you, and that's an additional cost. And then you've got the payroll costs of actually running the payroll. So all of that kind of eats into some of your tax savings. So I don't advise it. If you're losing money as an LLC because you're just getting started out, it doesn't make sense to do an S corp. Please don't do an S corp. But once you're making a profit of at least 30, then you can, it's worth doing the S corp. Carve out a portion to pay yourself a salary on, then the rest of it will be free of self-employment taxes. In terms of the salary, the tax code is purposely ambiguous. It says that you have to pay yourself a reasonable salary. And so what that is interpreted to mean is that you have to pay yourself a dollar amount that for what you do, that you would have to pay someone else to do it if you didn't do it yourself. So it's open for judgment and interpretation. Obviously, if you're just getting started out and your profits from your firm aren't that great, then you can pay yourself a smaller salary. The IRS isn't going to come in and audit you and tell you that you're not paying yourself a reasonable salary. Obviously, as your practice grows and you've got more profit, then you should increase your salary to get closer to the number, to basically what you're paying yourself is what you would pay your replacement. It's the easiest way to describe it. But again, you are allowed to take into consideration the profits from your business. How much can your firm afford to pay? And if it's not much, then, pay yourself something that, you would can reasonably justify to the IRS given your level of profit.
All right. And when you're talking about the, $30,000 or $50,000 profit threshold, is that after paying yourself?
Now that would be before.
Okay.
So,
Thanks.
so if you think about, if you were reporting all your income and expenses on your Schedule C, and that number that's left over would technically be your salary. That's your profit from the business. That's what you have available to you for, your personal expenses. So again, if that number, I mean, certainly let's just for sake of discussion, if that number is $150,000, that's how much you have available to pay yourself a salary, but you're going to pay self-employment tax on that entire amount. So versus if you have an S corp at that level, you can afford to pay yourself a $75,000 salary, pay self-employment tax on that number, then your profit remaining would be $75,000, and that portion would just be subject to regular income taxes.
Great. Thank you.
And just from that perspective, prior to, getting with Raymond, and I find this a lot with other attorneys as well too, like who are just starting out or, I didn't understand any of that in terms from a tax perspective and making everything tax efficient. And for me personally, I did see a significant difference in my taxes in working with Raymond in terms of, okay, determining whether or not like paying myself a salary in S corp. And so you do see I saw a significant difference in terms of my taxes and just the planning piece of it. Because I know there's a lot of attorneys who are just either starting out or, they haven't classified themselves as an S corp, and it's a big ding on your taxes, like that you have to pay out. And so just in making that shift that Raymond helped me do and get everything coordinated is good. And then you also think of it from a perspective of, okay, as your law firm grows, or later on, if you do want to sell your law firm, you see this track record of, okay, I've been paying myself a salary. It's going to cost me or to have another attorney or employee later on as my firm grows, and really structuring it that way so that when you do try to sell it or someone tries to purchase it from you, that whole entire business isn't tied up in your own personal income, that there's other people that you can replace. And this is the certain salary that you need projected. Just thinking in terms of future value of your law firm. Does anyone else have any questions? Well, I just want to thank everybody for joining, and thank you again, Raymond, for, helping us map out what the next steps are going to be for a successful 2021. Please feel free to reach out to Raymond and I. Here's our contact information, and we'll follow up with you as well in terms of, if you want to do a one-on-one with us or just have a virtual coffee, I'm always happy to do that. But I appreciate you taking the time out of your busy schedule to join yet another Zoom call. Hopefully it was informative, and we will have a recording of this as well too that we will share with you. So if you know anybody who needs this information, other attorneys, other business owners, we'd be happy to be a resource for them. So I truly appreciate you for being on here. And yeah, please feel free to connect with us on LinkedIn. Reach out to us individually, and just have a wonderful evening. Anything else, Raymond?
No, I just want to thank everyone for attending, and Cherish, again, thank you and your team for pulling it together. So please feel free, any of you, to reach out if you have any more questions or if you want to go into a little bit more detail.
Thanks, everyone. Have a good night. Bye.
Bye.